Over the last couple of weeks, we have seen some turbulence in markets, and most of this weakness is concentrated in the technology sector, semiconductors, and AI-driven stocks. And if you think about it, it makes sense. Technology and AI have been on a really strong run, and they have been the biggest drivers of the market this year. When one area of the market moves up sharply in a short period of time, it is completely normal for investors to start taking profits, reassess valuations, and ask whether or not prices have gotten a little ahead of themselves. To put some numbers around it, the tech sector has been down around 2.4% when compared to the S&P 500, which is down around 1.6% over the last 2 weeks. So this has not been an even sell-off across the whole market. Now, I never want to minimize market pullbacks. Nobody likes seeing their accounts go down even temporarily. But in general, we need pullbacks in order for the market to remain healthy. Pullbacks can help reset expectations, cool off areas that may have become overheated, and create a more sustainable foundation for future growth. As I always say, markets do not go up in a straight line in perpetuity. The important thing to remember is that a short-term pullback does not mean the long-term story is broken. We believe that AI is poised to reshape productivity, innovation, in the way companies operate over time. But being bullish on a long-term theme does not mean you want your portfolio living and dying on one area of the market. And that is why diversification really matters. While technology has been under pressure, consumer staples over that same period of time has been up around 1.6%, energy has been up around 1.5%, and utilities have remained flat. That's the point of diversification. When one area of the market has a tough stretch, there are other areas there to soften the blow. Now, on a separate note, we are starting to see inflation come back into the conversation. Gas prices are a big part of that because as they go up, they feed directly into headline inflation. And higher fuel costs will eventually show up in things like transportation, shipping costs, and the cost of goods. This creates uncertainty for the consumer, the Federal Reserve, and businesses alike. Then there's also the fact that we are entering the summer. At one time in your life, you've probably heard the old Wall Street saying, sell in May and go away. Just to be clear, we do not endorse that strategy. Trying to time the market is a very difficult task because you got to get it right twice. You got to know when to get out, and then you got to know when to get back in. But the saying exists because there is a trend that summers tend to be a little bit more choppy. That's because trading volume tends to be a little lighter. Therefore, headlines can move the markets quickly, and investors may react a little more sharply to new data. The takeaway is, volatility is normal, and pullbacks are part of investing. The goal is never to avoid every market decline. The goal is to build a portfolio that is in line with your risk tolerance so that you can stay invested throughout various market environments. I hope that helps. As always, please give me a call at True Compass Advisors if you have any questions.